You can share your screen. If not, I can share and show your website. What do you prefer?
Let me see if I can share my screen a little bit.
There's a little green box that says share, and you click that. It's in the drop-down menu. And then it'll show your screens, and you just click share.
Perfect. Let's go with the PowerPoint. Oh, I just lost my PowerPoint for some reason, but I'll bring that PowerPoint back up because it's my favorite PowerPoint.
Okay.
I'm
not seeing your screen yet.
Oh.
Did you click the share?
Yes, I definitely click share.
And then it
says
but start.
Once you do that, you get another screen that asks you which window you want to share or which screen if you have more than one. So
you have to select it.
Yeah.
Well, I hit that one too. So I thought that should have worked. I kept saying share to everything.
Okay, why don't you try it once again?
Try it again. Steve may not have had his screen unshared at the time. So.
No, I had.
Okay. Any luck?
Okay, so I hit share.
Yeah. Then you'll see the window come up and ask you which screen you want to share.
Yes. So I was saying all the things I wanted it to share.
Nothing.
All right.
You could only share one screen at a time.
I understand, but it sent me to my system preferences. So I even updated my system preferences. I'm going to ignore it all and say, I've got half of you so we can talk, and you'll just have to imagine the rest of this going on.
Okay, well, let me show your website. I'm going to share then. So why don't you I'm showing your website right now. Can you see Richard IFT up here?
Sure.
Okay, so what was your journey like that led you to this type of paradigm that you see? I'd go all the way to, the title of your book, How Bankers Rigged the World of Finance. Tell us about your evolving into this belief. How did it happen? What's your background?
Let me go back to 1980 to 82, when I worked for the Federal Reserve.
Okay.
And if you recall, it was a period of very high interest rates.
Volcker.
With Paul Volcker. And I had a fascination with what Wall Street was doing in terms of financial innovation to adjust to those high interest rates. For example, we created the money market funds really took off during that period. And the implication of the money market funds was they disintermediated the savings and loans. If you remember, we used to have these banks that took in money with the right hand and lent it out in 30-year mortgages. So when Volcker let interest rates rise, it destroyed their basic economic model because the value of what they had to pay for funds went skyrocketing, but what they were receiving on their assets didn't change. So they all went insolvent. If you recall, in the mid-'80s, we had
the S&L crisis, the Keating Five, and then in August of '82, the low in the Dow and the beginning of a 40-year bull market.
You got it. You got it. So,
and I'm curious. Well, I have a question. Was that also the same time that they developed the euro dollars in Europe, not the euro currency, euro dollars as a funding mechanism in Europe?
That was one of those time periods when that happened.
Okay.
So this was the time of financial innovation being driven by these rates. And naturally, in 85, 86, what they went to was they went to structured finance. Because banks pretty much figured out, we need to get these assets off of our balance sheet and get it into the hands of somebody else and
The
not
public.
take the public and not take the risk of these assets anymore. So that's finance really took off. And the S&Ls provided what I'm going to call the feed for this, because all those mortgages had to be repackaged out of the failed S&Ls. Fannie and Freddie weren't going to buy them up, so we had to move them into the marketplace. That is when you will see the takeoff in structured finance and the packaging into private label mortgage-backed securities.
Okay.
But we didn't just package into private label mortgage-backed securities. We also went to every other asset class you can think of, like car loans, credit card receivables, etc. Wall Street was very good at packaging. And one of the things they quickly recognized is investors were willing to accept whatever story they told about the contents of that structured finance package, which was very interesting to me because
you didn't know there were bag holders back then?
Yeah,
you didn't know there were bag holders?
They were the paper bag holders.
Okay.
Okay. So I actually invented a system so that investors could know what they owned, an information system for these structured finance securities. And the fundamental insight that I had for that system was you should be able to verify what you know, what you're buying. That's the basis of our financial system. If you do a search, by the way, on my website for the information matrix,
okay,
and I think and Holmstrom is the person who you should also.
Stiglitz.
Well, you could use
this guy.
Yeah, he's fine. That's one of the Nobel Prize winners who should have accepted long ago the information matrix. If you go down about a third of the way down, you'll see the information matrix in this post. And I'll be able to explain a little bit about the intuition behind the matrix a little bit further. You only got half the matrix. There, stop. What I did, imagine a physical model of two securities. And the only difference between the two securities is their transparency. One security is a clear plastic bag. And in that security, you can see it has a $20 bill. So if I asked you, Dale, would you buy that $20 bill from me for 15 bucks? What would you say?
Sure.
No questions asked, right?
Right.
It turns out, by the way, that I've just described with that clear plastic bag a number of the characteristics of transparency. You got to see with the $20 bill what is disclosed, and you also got to see when before you had to make a decision as to whether to purchase or not. So you could say, oh, look, $15 is a good price for that $20 bill. Right. What if I said $25? Would you buy it from me for $25?
Only if I wanted to have a date with you or something.
There you go.
All right. Go ahead.
Okay. So what we've just done is you showed that you would use the information that was available to you.
Right.
To make an investment decision. And as you also showed, you would only use that information, only make the investment if you concluded from your analysis of the information, you were making money on the deal.
Right.
Okay. That's all characteristics of our market, isn't it?
Well, I don't know. I know that a lot of people leading into the 2008 crisis were buying these derivatives and had no idea what was in them.
Wait, before you bought, these people bought it. Let's keep going on because I like that where you're headed.
Okay.
When I said it was $25, you said, thank you, I'll take a pass unless we're having a date.
Forget it, buddy.
Okay. That's another characteristic of the market. You don't have to invest in every security.
Exactly.
That's a very important thing. Because what happens is the market divides itself up on any particular security into those who are willing to go and invest in it versus those who won't. So, for example, if you couldn't verify, let's imagine a brown paper bag as my other security, and I tell you it has $20 in it. Now you have to trust my story, but you can't verify it.
Yeah, Ronald Reagan wouldn't buy it either.
Correct. You got it. So you might say, I'll buy the paper bag security, the plastic bag security from you for $15, but I won't buy the paper bag security for you for $15 because I can't verify. But it turns out there are investors who will trust my story that I've told you that there's a $20 bill in that paper bag, and they'll buy it for $15, sight unseen. That's the trust but no verified collection of people. See,
like the people who came into all these IPOs buying the dog and pony shows all over the country and internationally, and then once the IPO hit the street, most of them have really cratered. So you had willingness to buy the hope, but the reality ended up coming in, and a lot of them lost half their value.
Absolutely.
So people will buy a story.
People buy a story. That's, by the way, is a very important observation you just made. That's behavioral economics.
Okay.
By nature, people buy a story. We like stories. It's how we interpret the world.
Right.
We like a good narrative. Okay, so with that background, now let's go back and look just briefly at the 4 quadrants of the matrix. The perfect information quadrant is both you and I are looking at the $20 bill in a clear plastic bag. We both know what we're buying and selling. Okay?
Yep.
The lemon problem, 50 years ago, created by George Akerlof, or identified, I shouldn't say created, but identified. I'm a seller, and I've got the clear plastic bag view of the $20, but you're the buyer, and what you have is a paper bag view. That's an information asymmetry.
Yeah, huge disadvantage.
So, you got it.
To the buyer, yes.
Huge disadvantage. Now let's go to the other side, which is Joseph Stiglitz. He's the one who came up with the antiquity dealer's problem. He said, gee, if I'm selling an antiquity, the dealer knows what the value of the antiquity is. I'm the person who inherits the antiquity. I don't know what it's worth. So as the seller, I've got the paper bag problem.
Right.
The antiquity dealer has the plastic bag.
Sure. You could say that about pawnbrokers with gemstones and everything. Who hasn't been ripped off?
Right. Now, that was the state of the art in 2008 for economics profession. They had identified the perfect information quadrant, and they had identified the asymmetry quadrants. It never occurred to them that there was a 4th quadrant that has to be in that 2x2 matrix, which is both parties are viewing it as a paper bag. And let me give you an example of a security that you're familiar with that falls in that category. Banks. You have no idea what's on their balance sheet. I have no idea what's on their balance sheet, but the two of us could trade, you could sell stock, I could buy stock, or vice versa in JP Morgan.
Okay.
Okay. Pivotal point. We bought it on a story. I sold it on a story that said JP Morgan's going down. You're buying it on a story that says JP Morgan's going up. Neither one of us can verify the story because we don't know what's underneath it. We're buying the paper bag. Okay, you with me?
Yep.
1930s, we had a depression going on. And the question was, why did Wall Street collapse? And Ferdinand Pecora led a commission into it. And what he discovered was that Wall Street makes a hell of a lot of money selling opaque products on a story. And if you wanted to rein in Wall Street and make it the servant of the real economy, what you had to do was provide transparency. But investors couldn't force the issue because Wall Street was good at finding investors who would just trust. Remember, all investment, no investment requires every investor in order to go.
Right. Didn't Mark Twain say a mine is two liars standing over a hole?
Exactly. You got it. So what his discovery was, though, was somebody needed to force transparency. That somebody became the SEC.
Okay. So when was the SEC formed? As a result of
1933.
Okay, after the Depression, or in it?
During the height of the Great Depression.
Okay.
And it's formed exactly to assure that investors get the information they need to be able to verify the story told to them by Wall Street.
Okay.
Fast forward.
How does it do? What's its track record? Are they
SEC's
owned by
record,
Wall Street?
The SEC's track record until 1980 was fantastic.
Okay.
And
Then they sold out?
Well, they weren't sold out. I mean, they didn't sell themselves out.
No.
Ronald Reagan.
They're influenced.
And said, gee, your client, SEC, shouldn't be investors. It should be Wall Street.
Oh, okay.
That was the end of the effectiveness of the SEC. Because suddenly they had to consider what Wall Street thought when it came to the issues of disclosure. Now, Wall Street gets a concentrated...
They didn't do a great job with that, or Bernie Madoff would have been caught a lot earlier.
You got it.
If they were, that was their, what they call it, what's the word I'm searching for? If that was their...
reason for existence.
Yeah.
Yes, this is exactly the issue you're dealing with, Dale. Is in 1980, the SEC goes from being the investor's advocate for transparency to having to consider what Wall Street thinks about disclosure. Naturally, Wall Street campaigns against disclosure. So now go back to the story we just told earlier about the creation of structured finance, which was at the very heart of the financial crisis. The SEC had to come up with disclosure requirements for those securities. Disclosure requirements that left those securities being opaque. So investors didn't know what they were buying. Now, let's go back to something also that happens. Think about asset managers for a second. Asset managers sell their services by claiming to be experts. I listened to you guys, for example, talking about how you think this is a good place to buy versus this is a bad place to buy in the various trades. That's an example of expertise in action. If you are an investor, and you want to buy fixed income securities, you might not think that you know everything about fixed income, so you'd go to a place like a Fidelity or a Vanguard, and you'd want them to be managing your fixed income exposure. And the portfolio manager there gets up and he claims to be an expert at managing fixed income securities. But what he doesn't tell you is, oh, by the way, I'm going to buy fixed income securities.
Because I get a nice load on the fund.
No, not that I get a load on the fund. His compensation package.
That's what I'm saying, the load.
Okay, his load on the fund. There you go.
Yeah, okay.
So, but he doesn't tell you, oh, by the way, while I'm claiming to be an expert, I can't assess the risk of the underlying securities.
That's why everyone moved after the 2000 and 2008 experience to deciding to be self-directed, because they decided if anyone's going to lose my money, it's going to be me.
Yeah, you got it.
Not a salesman.
Well, but still, if you look at the fidelities, they're huge.
They still are, aren't they?
Okay.
Yeah.
We manage more money through the so-called institutional groups than we do on an individual basis.
Including things like ETFs?
ETFs.
Yeah.
All of that stuff, still institutional.
Okay. Is our ETFs opaque?
It depends upon what's inside of an ETF.
Okay.
So some ETFs, by the stocks that are in the ETFs, are definitionally opaque. There are ETFs that focus on financial stocks.
Okay.
All of them are opaque.
What would you say are transparent? Let's just fast forward a little bit. What would you say are transparent investments in today's environment? Are there any?
Yes, the most transparent ones can be found in the technology areas. If you look at biotech, for example, they do a very good job of telling you where they are in terms of development of the drugs that they're going to sell.
Oh, but come on, Richard. I've seen so many, like if a trial ends up not working,
No.
I've seen them. Okay, all right. But you're just talking
What
about the
I'm saying
information.
to you is, you know that the drug is in trial.
Right.
At that moment, you can now assess what is the risk of it successfully completing the trial versus what is the risk of it not completing the trial.
The stock being cut in half in a day, that's a risk. I've
Absolutely.
seen many of them. Huh?
Absolutely. The stock could be cut in half.
Yeah.
In a day. But you knew what the risk was when you were buying the stock. You could assess that risk. And therefore, you can adjust how much exposure you take to the stock based on its risk.
Okay.
And that's what's pivotally important here. All investing is a function of exposure versus risk.
How about commodities? Gold is pretty transparent, isn't it?
There you go. I like gold.
You see it. It's it's an ounce. It's yellow. It hurts if you drop it on your foot.
Yeah,
That's
again,
transparent.
It's transparent.
Okay, currencies. You're converting even those central planners, and that's what I really want to wrap it up with. I mean, you're talking about the banks rigging it. What about what central banks have done over the last 10 years to basically manage this economy? Central banks, the BOJ buying half the stock market, all the bond market. What's your attitude on that? Is that opaque?
Let me say, it's not that they're opaque. Let me say that what's driving their behavior and what they're doing is the banks themselves.
Yeah, they're owned by the banks.
They are
controlled, not owned.
Controlled. They're not necessarily just owned, but it's controlled. And they're controlled by fear of what would happen if they don't do something. Look at what the Fed just did with repurchase agreements.
That's what I was going to ask you.
In the last 2 months.
Yeah, all that money pumped in. And the banks are forcing their hand to do it by not lending to each other.
Exactly. And by the way, the banks haven't lent to each other since September 2008 because no bank that has money can figure out whether the bank that wants to borrow is solvent and can repay them.
That's amazing. Everyone, I mean, I always ask what happened to all that bad paper, all those derivatives. There's still an off-book type of asset?
Of course, they still exist.
They're off the books, but they're off the books.
Right. We have no idea what trash exists, for example, on Deutsche Bank's derivative book. But what we can pretty much rest assured is that all of the big banks have too much exposure to Deutsche Bank so that Deutsche Bank can't be allowed to fail.
Okay.
As a result, the EU, for example, and the ECB follow a whole series of policies to protect Deutsche Bank. In the US, we did the same thing in 2008, 2009, 2010. We followed a whole series to protect our banks as opposed to the real economy. So now what you have, I don't know if you saw the thing from the BIS.
Do we, so now, is it true, Richard, and this I think is pretty opaque, the potential for bail-ins, where really, if you read the law, our deposits aren't ours. They're the property of the banks, right? So if there's a failure, it may not be governments that bail out banks this time, but depositors. That's opaque, don't you think?
Yes, it is. The issue
Do you see the potential for bail-ins? More of them?
The potential for bail-ins is huge.
Okay.
I want to be on record for saying that.
You're on record.
However, having said
man.
that, I don't think any government right now is stupid enough to do that again.
Okay.
The reason is that when they did that in Cyprus, they thought they were being clever and they were getting the Russian oligarchs. But at the same time, what they managed to do was to nail the businesses that existed in Cyprus. And I'm not talking huge businesses, I'm talking small businesses who happen to have their payroll in a bank.
All right. So there was a lot of collateral damage.
Correct.
How about the war on cash, Richard, of things like Modi did in India?
I think that was a completely failed experiment, and we're not headed there. I know we have a Harvard
economist. How about Bitcoin? Is that opaque or is that transparent? Crypto.
Well, Bitcoin is transparent. My problem with Bitcoin is it's not a store of value in any remote sense of the word, nor can I buy anything really with it. Okay. It's not like a dollar. Okay. Where I can readily go to the grocery store and use it.
Yeah, because while you're standing in line, it would, the value would change by the time you got in line and they rang it up.
Right. And, you know, what's interesting about Bitcoin is clearly it's a highly manipulated market.
Yeah, so the manipulation is
all the rules
transparent. Transparent manipulation. What I want to ask you is the purpose of IFT. Is there a business model behind it, and what your goal and mission is with what you're doing, talking to us today, and how you're edifying the public?
If you take that first chart, it explains it pretty well.
This?
What I've done with the Institute is we have turned opacity into an asset class. So it's just like you could buy gold, you can buy stocks, you can buy bonds, you can, with the initiative, you can decide how much exposure to opaque securities you would like.
Okay.
Which is huge.
By your analysis describing them? Or doing research on them?
We provide a label. We say,
I see.
We use a simple label. And the simple label, the existence of it on a security says there's enough information so you could know what you own. You're going to still have to do your own homework. But there's enough so you could know. So when I was saying the tech companies, you can tend to know what you own. Whereas a company like JP Morgan, you cannot.
Okay.
Another example that I've used over the years, GE.
Yeah.
For years, I've said GE is an opaque company. You can kind of understand what they're doing with the manufacturing side of the business. But GE Capital, you have no idea what's going on in there. And you have no idea what they're now hiding.
Right.
And for the last couple of years, for the last decade actually, what you've seen is one disaster after another emerge out of GE Capital.
Okay. Well, I appreciate you coming here and talking to us about what you're doing. And uh, are you looking for people to sign up to be aware of your label?
Dale, thank you for
Again,
having me.
oh, it was interesting. So, uh, people just follow you on Twitter, Richard, or
Oh,
the website, or what?
I'm always looking for people who are interested in signing up for the label. People who want
You
to
mean
push for
people selling
transparency.
investments
These are
to
people
get?
who are buyers.
Oh, okay,
This is a buy side only sort of an initiative.
okay, all right,
Also, I like people who say, gee, is there any reason that the Fed shouldn't be forced to only lend against transparent securities? After all, if the Fed is lending against opacity, they're betting the taxpayers' money.
okay,
I don't think there's any reason, for example, that a pension fund should ever invest in an opaque security.
okay. Well,
Or
I appreciated that. You know, I'm all for transparency in an opaque world. So, good luck with your mission, Richard. I hope you have a great 2020, and you
same to
know,
you.
okay, thank you very much, and that you help people see the pitfalls of what they're speculating on. So, thanks again for being here, and you can find Richard. Here's his website, instituteforfinancialtransparency.com, and he has kind of a his Twitter handle is at TYILLC. So there's Richard. Maybe pick up his book. Is that a book?
Yes.
The Transparency Game,
Yeah.
and
Go
they
for the
could get
Kindle
it from
version.
you or anywhere.
They can get it off of Amazon.
Okay. All right, Richard. Well, Happy New Year, buddy.
Happy New Year to you. And as I said, good luck with your volatility next year. I think you're going to get a
All right.
lot of it in November.
All right. Thank everyone. That's Richard Field. Thank you very much. And that's a wrap for us. We'll see everyone for Turnaround Tuesday. Remember, don't just count your pips, count your blessings. And see you, Brock, Richard, Monica. Adios. Everyone have a great afternoon and get ready and prepped for 2020. Adios. Thank you,
Adios.
Richard.
Bye-bye.